I've done I've done these sorts of presentations for a couple of years now, and happy to be with you today, going through New Mexico gross receipts tax, which is always a fun subject. If you've ever dealt with it before, I'm sure you're aware, and doing business on the internet. So, again, my name is Ian Alden with Law for Small Business. So just a few quick disclaimers here. This presentation does not constitute legal or financial advice. It's really just informational. It's for your own benefit and information, but everyone's situation is different, and this can't really possibly encompass everyone's situation. So you definitely want to consult with your qualified tax professionals, lawyers, CPAs, etc., before you undertake any course of action. Additionally, this presentation doesn't create an attorney-client relationship. It really is just informational, but nothing in this creates a relationship where I am representing you. So if you need to engage a lawyer, I'd recommend reaching out and looking to engage one. So the presentation is going to cover a few topics. We're going to talk first about business taxes as a general overview, what they are. Because gross receipts tax is often conflated with a number of other taxes. Whenever someone calls me for a consultation, I have to spend 5 minutes disentangling the different taxes at issue, because gross receipts tax is very unique. And so in order to understand what it is, it's important that you understand what it isn't. So we're going to cover the different business taxes, pretty broad overview. I don't want to spend too much time on them, but it should be beneficial nonetheless. Then we're going to talk about gross receipts taxes. I tried to do who, what, where, when, and why, but there's just no way to sequence them that way. So we're going to talk about what they are, why we have them, because they defy logic unless you understand why we have this tax in the first place. Who is responsible for them? The answer is not what you might think. When do they need to get reported and paid? And where or how do they get reported and paid? Then we're going to turn our attention to e-commerce and digital service businesses, because this is a workshop about how gross receipts tax impacts doing business on the internet. And so we're going to talk about really the two different types of internet businesses that we deal with commonly, which is either e-commerce, that's selling goods, or digital services. A lot of my clients are, for example, consultants based in New Mexico who consult nationally. And so we'll talk about digital services as well. Hopefully your situation falls into one or both of those categories. And then we're going to talk about just a few other considerations. Sales taxes to other states, because in this glorious digital age, in the year of our Lord 2024, it's not just about tax to New Mexico anymore. If you are an e-commerce or digital services business with a national reach, you might actually have sales tax obligations to other states. And so it's important to understand that in the context of gross receipts tax, and so that you have some understanding of what you might need to do there. And we're going to talk about how gross receipts tax intersects with other taxes, because a lot of people mistakenly pay income tax on money that's also paid to the state in gross receipts tax. You don't really want to get taxed on tax money. It's an overpayment. So we're going to talk about that and what that looks like. I should also mention that we'll be taking questions throughout the presentation. You can use the Q&A feature or the chat feature of Zoom here. I'll be checking either. There might be times when I'm on a roll and I'll let questions build for a little bit and then get to the end of a segment and then cover them. And then we'll have a Q&A time at the very end of this presentation for any questions people might be holding on to. So to start with, business taxes, the most common tax, when you think of taxes, you're typically thinking of income taxes, because this is the tax that everyone pays in some form or another. I pay income tax on my W-2 income. If you are a business owner, you're paying income tax on your business revenue, whether in the form of pass-through taxes, which means it's taxed to you personally for your business's profit, or if you've got a C corporation, it's going to pay corporate income tax. There's all kinds of income taxes, but that's fundamentally a tax on income. Then there's the Social Security and Medicare taxes. So you've got two flavors of that. You've got what's commonly known as FICA, Federal Insurance Contributions Act. If you've got an employer-employee dynamic, you've got the employee paying their half of FICA taxes out of their paycheck and the employer paying their half out of, the paycheck. If you've got your own business, and you're a business owner and it's not taxed as an S corp, there's a good chance you're paying what's called self-employment taxes under a slightly related act, the Self-Employment Contributions Act. That's basically you paying both the employer and employee halves of Social Security and Medicare. Then there's payroll taxes. These are everything from the withholdings, like an income, Social Security, Medicare tax that you withhold from employees' paychecks, but they also include things like unemployment insurance, possibly workers' comp if you've got a state scheme that has direct payment of that. There's a few different payroll taxes that come into play. And then there's gross receipts taxes, which we're going to cover in depth, and some other taxes like franchise taxes, unemployment taxes, compensating taxes, et cetera, et cetera. But these are really the taxes that business owners have to deal with. And the bulk of this presentation is going to focus on gross receipts taxes. And so just to separate them out and have an understanding of what they aren't as well as what they are. So let's start with income taxes really quick. Owners of pass-through businesses have to pay income taxes, federal and state, on their net business income, which is basically gross income of the business minus allowable deductions and expenses. That income tax for owners of pass-through entities, like let's say you've got a partnership or a sole proprietorship or an S corp or an LLC taxed as any of the above. You've got what's called a pass-through entity, which means the profits and losses of the company pass through to the owners, and the owners are responsible for reporting the profits and losses on their personal tax returns and paying tax at their personal rates. So you might have a situation where you're paying income tax on the business's income at your personal income tax rates, federal and state. That's very common. If your business is taxed as a C corp, it's a little different. You've got the corporate income tax at that point, so your business will receive money and it will pay the tax, the income tax on that money. And so there's different styles of income tax, but that's kind of the gist of it, and that's the most common tax that people think of when they think of taxes. Got payroll taxes. Like I said, there's withholdings that you have to do from paychecks, Social Security, Medicare taxes. There's the employer's portion of those taxes. There's, all of these payroll taxes are what's called trust fund taxes. It's money that belongs to the IRS or to the state that you, the employer, withhold from paychecks and then hold until you pay it off to them. That's why they're called trust fund taxes, because you're holding them in trust for the IRS or the state. It's actually why payroll tax enforcement is the most aggressive tax enforcement. I tell people this in all my presentations, but if there's ever any tax to not fall behind in, it's payroll taxes, because those are taxes that even if they're owed by the business, they can be assessed against the owners directly in the form of what's called a trust fund recovery penalty. So payroll taxes, keep up with them. Then you've got self-employment taxes, which is, like I said, Social Security and Medicare. If you own your business and you're not a W-2 employee of it, so if we're talking like a sole proprietorship, partnership, or an LLC taxed as either, you're paying what's called self-employment taxes on your business income. That's 15.3% up to the Social Security cap, and then it's 2.9% after for Medicare. That is a common tax that you pay. You usually report that on your personal tax returns along with the income tax for the business, but in any event, that's a very common tax that you end up having to pay. Franchise taxes are another tax, very common. They're a tax imposed on a business for the privilege of existing. It's the nicest way to put it. New Mexico has a franchise tax on certain types of businesses, namely corporations or LLCs taxed as them. It's usually about $50 a year in New Mexico. There's some range and fluctuation, but it's about $50 for most people. And that's just a tax that gets reported to the state and then paid in its own separate return. And then there's compensating tax, which is closely related to gross receipts tax. It's kind of a way to avoid or to prevent tax avoidance for gross receipts. Basically, if you buy certain property outside New Mexico and then use it in New Mexico and you don't end up paying a gross receipts or sales tax, you'll get charged an alternative tax, which is called the compensating tax. Um, it it's a very odd tax. It doesn't apply to all purchases of property, but it applies to a lot of property that people overlook. So if you're buying, for example, a bunch of vehicles in New Hampshire, which doesn't have a sales tax, and then you're importing them into New Mexico, you'll likely have to pay a New Mexico compensating tax on the use of that property. If you have questions about the compensating tax, I would definitely talk to a good CPA because they can advise you as to whether or not your specific transactions qualify for it. If they don't, great. If they do, I'll cover how to file compensating taxes later because it really dovetails with gross receipts tax. Because like I said, it is meant to prevent avoidance of gross receipts tax. But that is business taxes in a nutshell. That's kind of it's very fast 30,000 foot overview of the different taxes that business owners are responsible for keeping up with. But that leads us into the bulk of the presentation and the real topic for today, which is gross receipts tax. Before I jump into gross receipts tax, are there any questions? I don't see any so far. So gross receipts tax. It is our state's equivalent of a sales tax, but it is not a sales tax. There's a very important distinction between them. If I go to a state like New York or Tennessee, where they have traditional sales taxes, and I buy something from a store, let's say I go and buy a $3,000 computer, and they charge a 10% sales tax. That's $300 in sales tax. The sales tax is imposed on the buyer of goods and services. So it is a tax imposed on me at the time I buy something. The seller is typically required to collect that sales tax from the buyer at the time of purchase. The seller holds that money in trust for the state or locality. It never belongs to them. It never belongs to the seller. It belongs from the start to the state. And then periodically, usually weekly, bi-weekly, or monthly, the seller will pay the sales tax it's collected off to the state. That is a sales tax model. The seller, even though they're involved in the transaction, is not actually a tax on the seller. So the seller isn't really in any legal jeopardy with the sales tax unless they either fail to collect it or they collect it and fail to pay it, which again, you go back to trust fund taxes, the feds and the state get really angry if you it's basically seen by them as embezzling. If you embezzle trust fund taxes, they get very angry about that. So, but that's a sales tax. Pretty much every state in this country either has a sales tax in the traditional sense, the one I just described, or they just don't have any tax on sale transactions. New Mexico and one other state that I'm not going to mention because it looks very different, but New Mexico is one of only 2 states that I'm aware of to have a gross receipts tax. It's like a sales tax, but the concept is flipped on its head because whereas with a sales tax, it's a tax imposed on the buyer, gross receipts tax is imposed on the seller of goods and services. This is very important because even though the seller usually passes that tax on to the buyer, which they're allowed to do, like if I go and buy something from Best Buy, for example, they're going to charge me the gross receipts tax, even though it's a tax imposed on them, and I'm obligated to pay it. They'll collect it, they'll pay it to the state. But even if they didn't, like let's say they said, you know what, we don't like this tax, we're not going to pass it on to you, they would still be obligated to pay that percentage of the transaction to the state because the gross receipts tax is imposed on the seller of goods and services, even if they don't pass it on to the buyer. This is a tax that is payable periodically. It's either monthly, quarterly, semi-annually, or annually. I'll cover the periods a little bit later. But you, the seller, have to typically set aside the money, or if you don't set aside the money, it doesn't matter, you still have to pay the tax. But you set aside and then you report the transactions, you report the income that's subject to the tax. and then you pay the tax to the state. You pay this tax to the state even though there's a locality portion. Localities tack on their own percentage to this tax. So like Albuquerque tax on an extra 2.5-ish% to the state level gross receipts tax. Santa Fe tax on more, and so on and so forth. But you pay it to the state, and then the state will pay the localities their share. So going into the basics of it, it is a tax imposed on businesses, on sellers of goods and services for the privilege of engaging in business. It's an excise tax, as they call it. The base rate as of July 1st, 23 is 4.78%. That's the state rate. And then, like I said, localities will tack on an additional amount on top of that. It's very important to understand this bit, and this is a fairly new development in the gross receipts tax. It happened just a couple of years ago. For most in-state transactions, because there are different locality rates depending on the locality involved, it used to be that the locality of the seller mattered. You would charge and pay gross receipts tax based on that locality. Nowadays, that's been flipped on its head with what's called the destination sourcing method. Now you charge tax for New Mexico transactions based on where the buyer is. So let's say you have an HVAC service company. You're based in Albuquerque and you go out to do a job in Santa Fe. You are going to have to charge and pay gross receipts tax at the Santa Fe rate, even though your company is based in Albuquerque and you just drove out there. There's an exception for certain businesses. There's a carve out for things like lawyers, accountants, architects, things like that, where even if your buyer is in some other location, you're never really leaving your own. So, you know, if I'm sitting here in Albuquerque and someone in Santa Fe hires me to write a contract, I'm never really leaving Albuquerque to do that job. And so there's an exception to the destination sourcing rule for that kind of business, but the default presumption is that you're collecting and paying gross receipts tax at the rate of the customer and their locality. So to understand gross receipts tax, you have to look at the definition of gross receipts because the tax is imposed on quote unquote gross receipts. And so New Mexico defines gross receipts as the total amount of money or the value of other consideration, meaning payment, from selling property in New Mexico, from leasing or licensing property employed in New Mexico. So if you're an out-of-stater and you own, you have, let's say, equipment here, construction equipment, and you're leasing it out here in New Mexico, that's considered gross receipts, even if you're out of state. From granting a right to use a franchise employed in New Mexico, selling services performed outside of New Mexico, the product of which is initially used in New Mexico, or from performing services in New Mexico. The big things there in that definition are selling property in New Mexico and performing services in New Mexico. That's going to be the bulk of what we look at here. There's performing services outside of New Mexico, the product of which is used in New Mexico. That's a pretty rare occurrence, actually. We'll talk about that in a second. But that's the definition of gross receipts. And we'll revisit that in a little bit here. But you also have to be engaging in business here to qualify for gross receipts tax. If you're not engaging in business, New Mexico can't tax the transaction. There's a thing called tax nexus, which we'll cover as well. But basically, you have to be engaging in business and you have to have gross receipts for gross receipts tax to apply. If you lack physical presence in this state, including marketplace providers, engaging in business means having basically $100,000 of sales transactions in the state. We'll talk about that more later as well. I see I've got some questions coming up. So if I'm doing an art show, I've got the first question here. So if I'm doing an art show, I have to charge the tax rate based on their locality. How about out of state? So I don't quite understand that question. We will talk about out of state transactions in a second here. But typically if you're doing an art show, let's say you've got an art show in Albuquerque, and then people come to your art show and buy art, they're buying art in Albuquerque. And so that would be That is a situation where they're buying art in Albuquerque. They typically take possession of it in Albuquerque, but either way, the transaction's occurring here. And so I think you charge Albuquerque rates there. It's a bit ambiguous, I'm not going to lie. There is some gray area in interpretation with the destination sourcing rule, but even if they're from Santa Fe, if you're in Albuquerque, the art show is in Albuquerque, and they are coming to Albuquerque to purchase the art, I would think you'd charge Albuquerque rates for that. Um, Again, don't quote me on that because I actually want to look at the rule a little more closely, and I will if we have time at the end of this. But in that sort of situation, I would feel pretty comfortable charging Albuquerque rates, just because the bulk of the transaction is happening in Albuquerque, if that makes sense. Like you look at where the art show is happening and where the transaction is happening. How about affiliate marketing, where I'm only recommending services and products and getting a commission when the customer buys? So affiliate marketing is its own can of worms. We can talk about that towards the end of the presentation, but affiliate marketing is odd because a lot depends on who you're getting paid by. If you are getting paid directly by the customer, that's one thing. You're basically providing a sales service to them where they are. But if you're getting paid by the product affiliate, that is either going to be tax based on where the affiliate is, or where you are, depending on where you're providing the services, or most likely, and this is what we'll talk about towards the end, if you are doing affiliate marketing for a company that is based outside the state and they are shipping the products from outside the state, it might not be taxable at all. How does a business owner deal with taxes we've already paid at the store for material and goods and then end up used and left at a job? Example, tile installation. If the business owner paid tax on the goods that are then used and left at a job, is there a way to get that, to back that tax out? Um, so there are some deductions in the gross receipts tax code that apply to resale of materials for construction. Typically, um, that transaction should only be subject to gross receipts tax once. And so you typically not pay gross receipts tax when you purchase the material for resale in a finished product. Um, I'll cover that more at the end if we have time, just because this is mostly about e-commerce businesses and that's not really an e-commerce matter, but I'd like to cover that if I have time at the end. But generally, you'd look at a reseller exception for construction materials in that situation. Do we report mileage and travel time compensation when paying monthly gross receipts tax? Two very different concepts. Mileage and travel time apply to income tax, not gross receipts tax. Gross receipts tax is a flat tax on the gross receipts from sales. You don't deduct things like mileage and travel time from gross receipts tax. And then So I'm going to move on with the presentation and then we can take some more questions after this next section. Can I pass the tax on to my customers' clients? Yes, you absolutely can, unless they're the federal government, you're allowed to pass the tax on. Um, I'll explain why in a second you can't pass that on to the federal government. Keep in mind if the buyer refuses to pay the tax, and I have this question a lot, people consult me a lot with this issue. The buyer says they just don't want to pay the tax. What do I do? If the buyer refuses to pay the tax, you either eat the tax, unless there's some non-taxable situation in play where the buyer, there's situations where maybe the tax doesn't apply for certain buyers, in which case if they issue an NTTC, then you don't have to charge them the tax or pay the tax. But if that's not the case and they just don't want to pay it, you either absorb the tax or you turn the buyer away and don't go forward with the transaction. And that's just kind of the reality of it. Because as the seller in New Mexico, you're responsible for that tax, even if the buyer won't pay it. Can I reduce or eliminate this tax obligation? Yes, you can, and this is a very important topic to understand. Um, if tax might apply, and there's a 4-point analysis here, but if tax might apply, there's a number of exemptions and deductions that are provided for in the Gross Receipts and Compensating Tax Act. Exemptions are categories of income that are not considered gross receipts. You're basically exempting that income from gross receipts, even if the larger definition might include it. And because you're exempting that income, it doesn't need to be reported in your gross receipts tax returns. So you can just leave that income out. Deductions are categories of income that do need to be reported in your gross receipts tax returns, which you have to do periodically, but they're not subject to the tax. You net them out, basically. So when asking if you need to pay gross receipts tax on something, the 4-point analysis looks like this. Is the income gross receipts under the broad definition of the Act? If it meets that definition of gross receipts, which again, you look at this definition up here, total amount of money or value of other consideration from selling property, performing services in Mexico, et cetera, et cetera. If it doesn't meet this definition, it's not subject to gross receipts tax, period. I mean, that it has to be considered gross receipts to be subject to the tax. Assuming for a second it is, then you look at, does an exemption apply? You look at the tax code and the list of exemptions, it's about a mile long. If an exemption applies, it doesn't need to be reported in the gross receipts tax returns. You may have a situation where you have a bunch of income that is not subject to gross receipts tax, either it's not gross receipts or it's exempt. You would still want to do a gross receipts tax return in that situation and report $0 so that tax and rev doesn't think you're a non-filer, just a heads up. But you look at if an exemption applies, and if it does, the income is exempt and doesn't need to be reported. If an exemption does not apply, and it is gross receipts, look at if a deduction applies. If a deduction does apply, you do need to report the income, but you can then offset that income by the deduction, which nets out, and there's no tax on the income. So you do the gross receipts tax return, you list the income, there's a section for deductions that you can claim, you pick the specific deduction, and then you say this dollar amount is subject to the deduction, and then you charge tax on the difference, like anything that's left over after applying the deductions. If it's gross receipts and no exemption applies and no deduction applies, the income must be reported and tax must be paid on it. So I've got one question in the hopper here. So if you were doing, I've got a question in here. If you were doing a wholesale transaction and the person will add the gross receipts tax when the item is purchased from them, how do you deal with this? Is this an exemption? It's not an exemption exactly. This is subject to what's called a non-taxable transaction certificate, an NTTC. Specifically, a wholesale situation where you're wholesaling to a retailer, you are selling something for resale. And so the retailer would issue to you, the wholesaler, what's called an NTTC for resale. That is the retailer certifying to you and to the state that they are buying these goods from you for resale in the state and that they will charge and pay gross receipts tax on those transactions. If you get that NTTC, you then do not need to pay gross receipts tax on that transaction, which means you don't need to pass that tax on to the buyer, the retailer. You do report the income and you report the NTTC that you are using with respect to that income. It's like a deduction. So you report the NTTC for resale, you report the transaction, and you end up not paying tax on it because you sold the goods for resale. That's a very common scenario because the state wants to avoid what's called tax pyramiding. They want to avoid the tax being assessed at every level of the transaction. Gross receipts tax is not intended to be a value-added tax like Europe has. So yeah, that NTTC would apply. So let's look for a second at why we have the gross receipts tax, because the logic is weird but important to understand. New Mexico's economy, as most of you know, is heavily reliant on federal dollars. There's a lot of federal government contracts between the national labs and construction contracts and subsidies and you name it. We just have a lot of federal money flowing in. relative to the amount of money that we put into the federal coffers, we are a net taker. And the federal government cannot be made to pay a sales tax. So the traditional sales tax, like I said, in New York or Tennessee or whatever, we could not charge the federal government a sales tax for buying goods or services from New Mexico sources, from the labs, from construction companies, et cetera. Any business whatsoever that provides services or goods to the federal government in a sales tax model, no one would end up being taxed on that transaction, which means New Mexico would lose out on a lot of tax revenue. So their solution was the gross receipts tax, which is a tax imposed on the seller of goods or services. So if you've got a bunch of people providing services to the federal government in the state of New Mexico, even if those sellers cannot pass the tax on to the federal government, they're still responsible for paying said tax to New Mexico. That's why we have the gross receipts tax. It's a way for New Mexico to get at some of that federal revenue that's coming in for tax purposes. Alternatives might be a larger income tax or et cetera, et cetera. There are alternatives to the gross receipts tax, but that's the path that we took. There are obvious downsides to the gross receipts tax. Even if the intent of that tax was largely to target federal dollars, because of constitutional issues, that tax cannot be targeted specifically at that money or people who provide services to the federal government. So it is a tax on all business activity in New Mexico, including without limitation, students working summer jobs. If you have a high school or college student getting a 1099, the state considers them a business owner, and that revenue is subject to gross receipts tax. College interns, plumbers, electricians, doctors, which is a huge thing because legally doctors cannot pass on that gross receipts tax to their patients. So those gross receipts tax paid by the doctors get folded into the cost of services. That's why one of the reasons why medical costs are X% higher than they might otherwise be is because the gross receipts tax is being factored into the cost of services. Lawyers and so on, I have to charge my clients gross receipts tax when I provide services because I'm subject to that tax. So it's a tax that has broad applicability. It casts a wide net that ends up catching a lot of people off guard, especially students. I have seen college students get audited by Tax and Rev for their internship money. It is an unfortunate situation. Who is responsible for them? Again, it's a tax imposed on the seller, but specifically it's a tax imposed on the business. This is important to understand because if you have an LLC and you're doing business, the gross receipts tax is a tax that's owed by the LLC, not by the business owners. Even if the LLC was called a pass-through entity, that pass-through nature applies to income taxes, self-employment, social security taxes, that sort of thing. It does not apply to gross receipts taxes. Those do not automatically pass through. So if you have a situation where your business owes a lot of gross receipts taxes that it has failed to pay, and that business is an LLC or corporation that's been properly run, there's no grounds to pierce the corporate veil, that tax debt lives and dies with the business. And it can pass on to future businesses through what's called successor liability. But the point is, it doesn't automatically inure the owners. The owners aren't responsible automatically for the gross receipts taxes of their business entities. If you are running a partnership or a sole proprietorship, which means no LLC or corporation, that means that the tax will be imposed directly on you. So I always recommend use an LLC or a corporation. Really an LLC, but sometimes a corporation. When do they need to be reported or paid? It depends on the amount of taxes that are owed. If you have a situation where your business is going to owe $200 or more in gross receipts taxes per month, they have to be filed monthly. If we're talking less than 200 a month, which averages out to less than 600 a quarter, they can be filed quarterly. If we're talking less than 1,200 every 6 months, they can be filed semi-annually. Or if you have a seasonal or temporary business, meaning you're only going to operate, for example, for the Christmas season or whatever, and you register that way with Tax and Rev for either a seasonal business or for a business of limited duration, you can just file once at the end of the duration or season or whatever. TaxRev automatically assigns you a monthly filing status when you register, unless you request something else. You can always request to have your filing frequency changed after registration using the update form. Unless you do that, though, the presumption will always be monthly. So just keep that in mind. Where do taxes need to be reported? They need to be reported online. Historically, Tax and Rev has accepted paper filings for this, CRS returns and whatnot, but they're really trying to move away from paper filings. I have clients who still somehow get away with doing paper filings, even though they're not supposed to, but really, Tax and Rev says do this online. So you can go to this website I've linked to here, the Taxpayer Access Point, get a business tax ID number if you don't already have one. Once you have one, register for your TAP account. You usually get them at the same time. And that TAP account is just a web portal like every other portal you've ever used, like your online banking portal or whatever. You log in, you can see your business in there, you click on it, you can see a spot for filing, preparing tax returns, specifically gross receipts returns. If you are overdue, it'll give you an annoying red notice and let you know you haven't filed. But that's where you prepare them, that's where you file them. Like I said, even for $0 returns, that's where you would file them. So before I move on to this section, I've got a couple more questions in the queue. Someone says, I provide a service, maritime recruitment. I get paid by maritime companies located on coastal US for work done at sea. I travel to maritime academies and schools and conferences to recruit mariners and clients. I invite mariners to apply on my website. My tax person doesn't think I owe gross receipts tax. I don't know how to figure this out. So that's actually a lot to unpack. You've got different layers of transactions there, but just 30, a very quick shoot from the hip opinion on that. You probably don't owe gross receipts tax on that because you're either providing services physically out of state if you're traveling to maritime academies and schools, that's work done out of state, or you're providing services to out-of-state buyers located on coastal US outside of New Mexico. And we're going to cover services to out-of-state buyers in a second here. You'll likely have to report at the very least the services provided in state for out-of-state buyers. I'll cover that in a second. So you might have some obligations for reporting, meaning you have to do the gross receipts tax returns and list some income, but then there's likely a deduction that's going to apply for you. So I don't know that you owe gross receipts tax on any of that unless you have New Mexico customers. So now let's look at e-commerce and digital services businesses. Now, a lot of people have an understanding of this that might be a bit out of date or might just be a little erroneous. Your digital service or e-commerce company is still subject to gross receipts tax, especially if you're based here in New Mexico. There's a lot of deductions that apply, but they're deductions, not exemptions. I know a lot of people, a lot of clients of mine who got started with me because they assumed that their sales to out-of-state buyers were just non-reportable because they're to out-of-state buyers. Especially if they were doing only out-of-state transactions, they just never bothered doing returns. And then Tax and Rev came out and audited them because they saw all that business income on income tax returns, either Schedule C or K1 or whatever, but there was no corresponding or related gross receipts tax returns. So they just assumed non-filing. You will still need to file gross receipts tax returns for your business. Your transactions are either going to be taxable or typically deductible, depending on whether they're in-state or out-of-state customers or clients. So the taxability under gross receipts tax depends primarily on whether the transaction involves sales of goods or services, because they're treated differently. Goods and services are treated very differently here. Where the seller is located, I'm going to assume for this presentation that the seller is located in New Mexico. And then you look at where the buyer is located, where the goods are delivered, where risk of loss passes to the customer, where services are provided, and whether the product of those services is received or used by the customer in or out of New Mexico. All of these things really matter for determining if your transactions are taxable, deductible, or otherwise. So we're just going to go example by example through some transactions that you're going to commonly see with web businesses. The first is sale of goods by a New Mexico business to a New Mexico customer. This is pretty straightforward, generally taxable unless some other exemption or deduction applies. Generally taxable based on the locality rates of the customer. There's some exemptions here, or exceptions to, again, the destination-based sourcing rule. But by and large, you look at the locality rates of the customer. The Gross Receipts Tax and Compensating Tax Act. Keep in mind, this act is littered with carve-out exemptions and deductions for very specific industries that have been favored by the New Mexico legislature. There's not a nicer way of putting it. It's pet industries. For example, gross receipts of horse jockeys, trainers, horsemen, and the racetracks actually are exempt from gross receipts tax because the legislature decided they like that industry. So really, before you pay taxes, I would recommend consulting with a CPA to see if some industry-specific exemption or deduction applies. I'm going to assume for purposes of this presentation that none apply, but you never know until you ask someone. But generally, if you're in New Mexico selling to someone in New Mexico, that's an obvious example of a taxable transaction. Let's say you're selling goods, you're based in New Mexico and you're selling goods to an out-of-state customer, someone in Texas, for example. This is generally deductible under a statute I mentioned earlier, 7-9-57, or I'm sorry, 7-9-55. This is a transaction in interstate commerce, and the US Constitution and the federal government do not want states unduly interfering in interstate commerce. And so there's a deduction there, 7-9-55 for sales to out-of-state customers, because those are sales into interstate commerce. There are some exceptions to that. If the buyer takes possession of the goods in New Mexico, so let's say they've got their buyer with the Texas address, but they're taking possession in Hobbs. They're taking possession in New Mexico, so it's not deductible, it is taxable. Unless they're in the oil and gas industry, because there's a whole nother set of exemptions for that. Or if the buyer is a New Mexico resident who requests delivery outside the state. If I live here in Albuquerque and I've got a PO box in Texas, I'm going to request that you deliver to my Texas PO box, even though I'm based in New Mexico. That is taxable, even though delivery is happening out of state, because I, the buyer, am based in the state. You can never truly know with some of these things, especially if you don't collect separate addresses or if you don't ask that question. If people provide you an out-of-state address, there's a presumption on your part that they're an out-of-state buyer, and you can only be expected to do so much to verify that. But just know that that is an exception to this deduction. Example 3, sales of goods by out-of-state businesses to New Mexico customers. This is a fun one that people often misunderstand. If there's, for example, a Texas-based business that's selling into New Mexico and they don't have a New Mexico footprint, they're not subject to New Mexico gross receipts tax unless they do enough in sales in the previous year. Like if in 2023 that Texas-based business had $100,000 or more in sales into New Mexico, for 2024 and beyond, they would be subject to New Mexico gross receipts tax, even though they're based in Texas. So in the year 2024, the reach of the state is not as limited as it used to be. And this is something that is very commonly misunderstood. This state and other states can reach at businesses located outside their state borders now. Looking at services, because like I said, they are treated differently. Sale of services by a New Mexico business to a New Mexico buyer. Same thing as sale of goods, generally taxable unless some other exemption or deduction applies. But if you look at sales of services provided in New Mexico by a New Mexico business to an out-of-state buyer. So let's say I'm sitting here in New Mexico and I'm going to do a video consult for someone based in Wisconsin. Is that transaction taxable? No. It's only taxable if the initial product of the service was first received or used in the state of New Mexico. A common example of that might be a machining service. If I am providing a machining service to a Wisconsin company with a New Mexico branch, or some kind of activity here in New Mexico, and I'm doing the work and I'm delivering it to them in New Mexico, they're using it in New Mexico, even if they are technically a Wisconsin taxpayer. And so that would be taxable. This is a really weird one, and people really struggle with this. But as a general rule, if you're doing something like consulting or marketing or web design, unless there's an actual New Mexico tie to the end product, like if I'm doing web design or creation and then I'm going to host that website on my New Mexico-based web server, that might be taxable because the initial product of that is received in New Mexico where it's hosted. But otherwise, generally speaking, if I'm providing remote services for someone, it's not taxable. But it's deductible, meaning I have to report that income and then I'm going to claim this other deduction here, 7-9-57, providing services in New Mexico to out-of-state buyers. So I have to report that income on my gross receipts tax returns, and I'm going to claim that deduction. So that's the long and short of it on services to out-of-state buyers. And so the question that I got a couple minutes ago about maritime academies and providing services, either going outside the state or maybe being in the state but providing services to buyers who are based out of state. If you're in state and doing the work here in New Mexico for an out-of-state customer, it's reportable but deductible. If you are outside the state of New Mexico, like if you physically leave the state and you're providing services to someone out of state, that does not meet the definition of gross receipts. Going back to the definition here. The definition of gross receipts includes from selling services performed outside New Mexico, the product of which is used inside New Mexico, or from performing services in New Mexico. If you are providing services outside New Mexico and the product of those services is initially used outside New Mexico, it's not gross receipts. And so it's not even reportable. Okay. So looking at that, again, out-of-state services to out-of-state buyers, not considered gross receipts. There's some rare situations where providing an out-of-state service to an out-of-state buyer involves the product of the service used in New Mexico. Something like an architectural firm, like let's say I'm an architect and I'm going to physically go out to my Texas client's headquarters and I'm going to provide some drafting services for a new building. I'm doing the architectural work, drafting it, and they're going to take the product of that service and they're going to use it to build the New Mexico facility. You could argue that the initial product of that service is being used in New Mexico for the first time. And so that would be taxable, even though I'm providing the service out of state to an out of state buyer. So it's, there's a lot of nuance to these rules, which is why I highly recommend if you're in a situation where it's not clear cut, use the services of a good CPA or tax lawyer. Some best practices for tracking and reporting these transactions and lowering your audit risk. Always, always, always require addresses from your buyers when you're doing web sales. Don't do web sales and only take an email address or a phone number or something, because if you do that, you have no way of substantiating any deductions you claim. And if you can't substantiate it, the presumption is that every transaction is subject to tax, which is fine if you're willing to just tax every transaction and pay that off to the state. The state is totally fine being overpaid. They don't care. But if you're looking to avoid having to charge your customers that tax or having to pay that tax, you're going to need to collect substantiating information and documentation. And so in your web transactions, always require the address. It helps if you have some kind of record keeping in the form of like email invoices or some sort of exportable records that would include the address. So that way, if you ever get audited by the state, you have a way to provide that information to them. You provide them information that says, on this date, I was paid this much by this customer who lives at this address, which is either in state or out of state. If you can have some sort of exportable data format for that so that you can provide that to tax and rev in the event of an audit, that'll make your life and the life of your CPA or tax attorney so much easier. So always collect that information. Always file gross receipts tax returns by the due date, because tax and rev has a fondness for auditing non-filers more so than for filers who they think might be underreporting. If you're a non-filer, that puts you high up on their radar. So always file the returns by the due date. Always report the income subject to deductions. If the deduction applies, you still have to report the income, report that income. It helps because that way tax and rev and their computers can reconcile that income versus what they see on, for example, your Schedule C or your K1s or other business income returns, so that they feel the full scope of income is being accounted for. Be sure to separate out the gross receipts into the correct localities. Again, it's just kind of important to do. Choose the correct deductions for the income being reported. Don't lump them all into a deduction that doesn't actually apply for everything. You can use more than one deduction in a gross receipts tax return, so make sure you're doing it properly. And maintain records for at least 8 years, because tax and rev has a 7-year audit period, 7 years from when remembering right, from when the return was due. So you want to make sure that you're keeping the records for at least 8 years. Now I'm going to cover more questions here. I've got a question. I started getting a 1099 for commissions earned. Do I need to report gross receipts tax, or can this all be handled while filing my personal income tax? Great question. He says, I don't own a business per se. I just earn commission based on transactions I complete. Fantastic question, because this throws so many people off. Because you're a 1099 contractor, you don't think of yourself as a business owner, but the state of New Mexico does. If you have 1099 income, that income is presumed to be subject to gross receipts tax, unless it's subject to some kind of an exemption or deduction. And so what you would do, let's say you don't have an LLC or a corporation or really any business, like you're not doing business as some kind of alias, it's just you individually. You go to that website I linked to, the taxpayer access point, and you register for an account for yourself. It's an individual account under your social security number, because that's what the 1099 will be issued to. And then you do the gross receipts tax returns under that personal account. In the eyes of the state, you're a business, even if you're just a 1099 contractor. So gross receipts tax does apply to you. This is where most audits come from, is from 1099 contractors not realizing that they're subject to this tax. So great question. Yes, you need to do this. So let's talk about South Dakota v. Wayfair. It's a case you may or may not have heard of, but it has huge implications for the gross receipts and sales tax. Before 2018, states could only impose sales tax or gross receipts tax on businesses with a physical connection to them. If you had a company like Amazon, is a very commonly cited example, or Wayfair, as is the subject of the lawsuit, who was selling into your state, but they weren't physically based in your state, you couldn't charge them sales tax. In 2018, that changed, because in this digital age, and with all these businesses doing national sales, it was severely undercutting states and their ability to tax transactions, and it was undercutting businesses local in those states. Because if I have a business in New Mexico and I have to charge New Mexico gross receipts tax to my customers, whereas a business based out of state does not, why would my customers pay 8% more to do business with me? It was a huge burden for small businesses, especially. In 2018, the Supreme Court changed this. Now states can and do require that out-of-state businesses charge and pay sales or gross receipts tax if there's sufficient economic nexus. If in a given year they're doing at least 100 to 200 transactions or $100 to $200,000 in sales, in subsequent years they'll be required to charge and pay this tax as though they were local companies. So this is all to say for your businesses, if you're a New Mexico-based web business and you have a national reach and you are doing a lot of business in some other state, for example, California or whatever, you should check with your CPA or tax attorney to see if you have enough nexus in those states that you're doing business in to where you need to charge and pay sales tax to those states. Because even if you don't have to charge gross receipts tax to those out-of-state buyers, you might have to charge a sales tax to them for their own state. And so in this global national digital age, this sort of thing matters. So just keep this in the back of your head. If you've got a lot of business you're doing in another state, you might have a sales tax obligation to that state as well. And finally, intersection with income taxes. A lot of people mistakenly pay income tax on money that they already paid to the state in the form of gross receipts taxes. You do not need to do that. Specifically, and I'm going to give you an example here. Let's say you collect 100 grand in gross receipts from sales. Then you have the 7.625% Albuquerque gross receipts tax rate, and you collect that from your customer. You've collected $107,625 from your customer. 100,000 of that is yours. 7,625 of that belongs to the state in the form of gross receipts tax. You pay that money to the state. You are left with $100,000. A lot of business owners mistakenly pay income tax on the full amount they collected, which means the 107,000, even though a lot of that was tax that was payable to the state. That $7,625 is not taxable business income for income or self-employment taxes. You just need to make sure that you deduct it from your business income before paying tax on what's called the net business income. It's a very specific deduction that you need to take, but if you don't take it, you could end up paying income tax on money that isn't really your income. So keep that in mind. Most CPAs know this and do this automatically, but if you're, for example, turbo taxing it up, your Schedule C doesn't automatically suggest this because TurboTax doesn't really understand gross receipts tax. In a sales tax context, this doesn't matter because the money you collect is never considered your income in the first place. It's held in trust for the state. But for a situation like New Mexico, you have to make sure you manually take that deduction. Otherwise, you're going to pay income tax on the money that was paid to the state in gross receipts tax. Okay, so that is the end of the presentation. Let me cover the remaining questions in here. What about selling a product to someone in another state from New Mexico, i.e. New Mexico to Colorado? Do we as sellers need to be aware of any sales tax in Colorado for that customer? That depends on Colorado law, which I can't advise you on. I don't know Colorado's economic nexus rules. But if you don't have a physical presence in Colorado, the presumption is no, unless you're doing enough sales into Colorado to where you hit that threshold. A guidepost is 100 transactions or $100,000 of sales. If you're doing at least that much, either 100 transactions or 100,000 in sales, ask your CPA or tax attorney if you need to start collecting and paying sales tax to Colorado. That would be my advice to you in that situation, because I don't know off the top of my head, but the answer really depends on how much you're doing in sales. Does New Mexico Tax and Rev offer a course for new business owners on how to file and what exemptions and deductions are allowed? No, not as such. The Taxpayer Access Point has some FAQs and walkthrough videos for how to prepare the returns, but that's not going to give you advice on what exemptions or deductions will apply to you. And Tax and Rev makes it a point to say that they will not advise you. That's not their job. And that's not their role, and they will not provide advice to taxpayers on what exemptions or deductions are appropriate for them. That's why it's really important to have in your corner a good CPA or tax attorney. As a tax attorney, I recommend a CPA first. Good CPAs are worth their weight in gold. They will help you with tax prep, and they will give you good advice on what deductions or exemptions to claim. So a good, real certified public accountant is a good person to have in your corner. Does the self-employment tax kick in for an LLC, and is there a minimum revenue amount? Yes and no, respectively. The self-employment tax is a tax imposed on the income of like any business income. So, except for S Corp income or C Corp income. So if you are the owner of an LLC treated as a disregarded entity or a partnership, you're subject to self-employment tax, which means 15.3% of the business income. And so that's basically the employers and employees' half of Social Security and Medicare, and you will need to pay that to the feds. Question one, if I pay gross receipts tax for miscellaneous income, should I also expect to pay taxes on my tax return for this income? Yes. And this is why we covered the different taxes that businesses are subject to, because you have income tax over here and gross receipts tax over here. They're not exclusive or mutually exclusive. It's not one or the other. It is both. You pay gross receipts tax on the gross receipts as defined by the state. You pay that to the state. You pay income tax on your business income and you pay that to the feds and to the state, but they're different taxes, and paying one does not exempt you from the other. You have to pay both. Question on GRT filings. When selling from Bernalillo to other counties, should the filing be divided per county? Again, it depends on what you're selling. If you are selling services where you're physically going to those other counties, you're going to be reporting per county. Finally, what's your recommendation on finding or interviewing a good CPA in Albuquerque? My only recommendation, because I'm not allowed to recommend specific vendors or providers, is that they're really a CPA, certified public accountant. There are plenty of people who are bookkeepers or accountants, and I'm not knocking them, but CPAs have specific education, continuing education requirements and licensing requirements and standards and professional oversight, which means that if they are not keeping up with a certain standard, they can cease to be CPAs. So I recommend finding a good CPA who's actually a CPA. And then last question in the chat. Let's see here. The very last question is, oh, so helpful. Thank you very much. So thank you all. Afraid we're out of time, but thank you all for attending. I appreciate your thoughtful questions and your attendance, and please feel free to reach out if you have any follow-up questions. I'm more than happy to chat with you, and we can either see if this is something we can help you out with as a client, or maybe I can just help point you in the right direction. And thank you for hosting me today. I very much appreciate the opportunity to give this presentation.
Of course, thank you. Thank you everyone for participating today. It was a really helpful. It's a lot of information, really helpful. Thank you for that. Thank you for you and the Law for Small Businesses. They're always, you and Larry and all of your team are always helpful on all this type of workshops. So I'm not sure if I can make recommendations, but I really recommend you guys. You guys are awesome. So please stay tuned. You can visit our calendar for more webinars to come. With Law for Small Businesses, I think we have 2 or 3 topics more to cover. They're great topics. So if you can join us for future presentations and for other topics too, like with other vendors in HR, we will have some workshops. So yeah, plus I recommend visit our website nmmgrt.com. So thank you, everyone. Enjoy the rest of your afternoon and day. So see you soon. Bye.